volatile short-term period following the failure of Silicon Valley Bank in the US and I guess more recently the bailout of Credit Suisse by UBS in Europe. Straight off the bat, we cut back our financial holdings to an underweight position, which was the right thing to do. What we have remaining in financials are good quality, well-capitalized businesses, and actually we think they'll navigate through this period absolutely fine. The portfolio itself, well, it's got less debt than the market. It's got more stable earnings, and during these periods, you tend to see a flight to quality, and that's what we've seen in the portfolio. So our stocks have held up fairly well. And then, how are we reacting now? Well, we quite like as stock pickers volatility because it gives us the chance to buy some good businesses at good prices. So, we're looking into the market, looking at our watch list to see if we can pick up some good investments for the future.
So after a period of outperformance in both 2020 and 2021, unfortunately, the trust underperformed in the first half of 2022. The markets fell significantly, and normally we'd expect our quality growth bias in the portfolio to protect us in those markets. But it was a very unusual market where where value led the market, so energy was the best performing sector, and defensive quality areas such as healthcare were the worst performers. You did have this point last year where a lot of market participants viewed Europe as pretty much uninvestable because it had war on its doorstep and a potential looming energy crisis. But since then, we've seen a marked recovery within markets. The energy crisis has abated somewhat so far, and Europe's well positioned for China reopening. And we've also seen an improvement in the trust's performance. So last year, in the first half, a lot of the quality companies were still delivering operationally, but interest rate rises meant that their share and their valuations were derated. But people weren't appreciating the fact that they had the pricing power to deal with inflation, and that they also had the resilience to deal with a recession if it comes. And we think finally you've seen the market recognise those qualities in those companies, and the trust's performance has improved as a result.
As alluded to earlier, we like volatility. It gives us the opportunity to buy good businesses at good prices. And as we've already discussed, we've seen a lot of volatility over the last 12 months and a lot of volatility recently. So it's been a good opportunity for stock pickers. Principally, we've used that to buy some great businesses at great prices. Two recent examples are the drinks businesses Campari and Remy Cointreau. Both have superb, long-standing heritage, have really good track records of capital allocation, and we believe will deliver good growth over the long term. And they've fallen back within our market cap range over the last 12 months, and we've taken that opportunity. They've both got slightly different dynamics in that Remy is more exposed to growth in China and emerging markets, whereas Campari is more exposed to sort of the penetration of apparel in the Western market. So they sit quite well together in the portfolio. We've also had to acknowledge that this market cycle is different from the last one, and there are emerging priorities coming out. Energy security, for example, was a clear change in the previous cycle to now. There's been a decade at least of underinvestment in the area, and we think a new capital cycle is driving growth there. So we've invested in two energy services companies, TGS, the seismic company, and Schoeller Blackburn, the energy equipment company. And we've also are looking towards areas such as automation, which will benefit over the long term from tight labour markets and also reshoring. So, for example, we bought a Swiss company called Cardex, which is the leader in intralogistics automation solutions. So overall, volatile period, good for stock pickers, and we've been active in adding good businesses at good prices to the portfolio.
Sam's just alluded to a couple of companies we've bought with great brands, and I'll talk about another one, which is an example of how a European small and mid-cap stock can have a leading global brand, and it's Lotus Bakeries, and they own the Biscoff brand. So they currently make over 7 billion biscuits a year, but they've still got a huge runway of future growth as they look to capture new markets like the US. And they've got a tried and tested playbook of how they do this. So, for example, in the US, they've partnered with the airlines. So if you buy a coffee on an airline, you'll get a Lotus Biscoff biscuit with it, so you get used to the taste. And you've also seen them have tie-ups with companies like Krispy Kreme and McDonald's. So there's a lot of future growth there as they take this brand out and try to capture what is clearly a big retail market. But it's not the only brand that they have. So they also have Naked, Trek, Kidalicious and Bear. And those brands all feed into the kind of natural snacking segment. So they're UK brands, and they started off in the UK, and the UK is well ahead of other markets in terms of the demand for those types of snacks. But Lotus are then taking those and plugging them into their well-established European distribution network, seeing as Biscoff obviously started in Belgium, and has got a lot of runway in terms of growing those brands too. In terms of governance of the business, the CEO is the grandson of the founder. They've got a long track record of making good capital allocation decisions, and they're still major shareholders. So they're very much aligned with us as shareholders in the trust.
My example is another global leader that just happens to be listed in Europe. It's called Engcon. And it's the market leader in producing tilt rotators. It has a 45% global market share. Tilt rotators sit between a excavator arm and the digger bucket, which allows the digger bucket to rotate and flex 180 degrees or 360 degrees actually. And this makes the excavator far more productive, and it allows it to do many more jobs, which allows you to, saves money. You need less excavators, you need less employees, and it saves on fuel. So it's really a productivity tool. Now, the long-term growth of this is for penetration outside its core markets. Within Scandinavia, about 80 to 90% of excavators sold will have a tilt rotator, but outside Scandinavia, it's between 2 to 6%. And what we're seeing now is as people appreciate the improved productivity, the high return on investment of buying a tilt rotator, this penetration rate accelerating. So we would expect the penetration rate maybe not to reach Scandinavian standards, but to move up fairly quickly over the next 10 years. And that's going to deliver a lot of great growth for what is the market leading European company.